Hi, welcome to the Raising Expert podcast. This is a podcast for founders raising or planning to raise pre-seed equity investment. We provide tips and advice on attracting investment from the right investors. You can listen to interviews with entrepreneurs sharing their investment secrets and experts giving their advice and tips. My name is Finlay. Thanks for joining me. And now, on with the show. Hi there. I'm going to do a little solo episode this month. A couple of things that I've been mulling over, and I thought, maybe I'll just kind of talk them through on a solo podcast. I think I've got them pretty clear in my head, but it kind of helps, doesn't it, to say these things out loud sometimes, and then I'll maybe tidy it up a little bit in my thinking. I've been doing some really interesting work over the last few months with groups of fairly early stage founders in a kind of accelerator setting. Carrying on one-to-one work as well, but when you see groups of businesses, at a similar stage and experiencing similar challenges, it's maybe more striking. So as you know, I'm kept pretty busy working on investor readiness in these settings, and often I'll deliver a kind of generic session and then pick up on a one-to-one kind of clinic sessions or just the traditional one-to-one meeting. And there's something that keeps coming back, and at first glance it looks like a tiny little difference, but actually I think this gap is really critical in the whole process, or the success, maybe more importantly, of early stage businesses connecting effectively with, let's say, angels, equity investors, early stage equity investors. And the difference is, it sounds just like a definition. It's investor ready and investment ready. And so what do I mean by that? Actually, there's a term or a stage before that, and this is where I, because of my work and the nature of it, this is where I pick businesses up. So there's an investment need, right? And then I probably work through the space that is investor ready, and at the top end of that, once we get to a high level of preparedness, of investor readiness, we try and engage with investors. Now, yes, of course, there's maybe early stage dialogues or reaching out during that process. That's probably best practice. But once we feel, and listen, it is better if there's someone coaching you or advising you, and this is maybe part of the issue here. It's not just a pitch for business, okay? Then we get the introduction or serious engagement with investors through the pitching events or talking to them on a one-to-one basis or whatever it is. And the critical thing is that it's the investor that decides if the business is investment ready. And there's a really, really big space here, I would say, from the investment need. A business wakes up in the morning, maybe in the middle of the night, unfortunately, I need investment. there's quite a process and a lot of work. And I think it's maybe underestimated how much there is actually in that that piece of work to get to the point where the investor decides, yes, you're investment ready, and the kind of intensive period of due diligence just prior to that decision being made. There's often a quick no, okay, but if we get into the maybe stage, and the work to accelerate that phase as well is probably underlooked. So the words of warning are: don't think that because you as a founder feel there's a need for investment, that investors are very quickly and easily going to agree with you. Okay, this takes a lot of convincing and a real slow period from your investment needs to investment ready. I've seen 9 months, right? A real quick one, 3 months. But there's lots of hard work going in before that. Okay, so that's just kind of word of warning. And so what do we mean by investor ready? I mean, what I say is that there's lots and lots of soft stuff, but if we could just break it down into a suite of documents or files, if you like, very fundamental. Sorry, I still talk about business plan. And, part and parcel of that, or aligned to that, is a really strong suite of financial information, cash flow forecast, profit and loss, historical, hopefully, and projected balance sheets, right? Standard sort of stuff. But a level of sophistication in there as well in terms of unit economics. If you've got some data presently, which connects some really strong marketing skills and information right into the numbers. Okay, so that's the sort of level of information of those traditional documents that we'd be hoping to see or create during this period. And we're getting a bit closer to investor ready. To summarise all that, then we create a really nice looking, engaging pitch deck. And from that, we summarise into a 1 or 2 pager, which is maybe easy to circulate and easier to digest, more appealing than 12, 24, 36 slide deck even is. But there's got to be the substance in behind that as well. So, the intellectual property has actually got to be protected and documented. The team in place, or a recruitment plan to bring them in place. So then we're starting to look at what we call the data room, and some of these other documents, the business governance documents, the intellectual property, that's there ready for review. And that's what allows investors to get to that, yes, you are investment ready, positive decision much, much quicker, right? Rather than asking for it and this going backwards and forwards between them or their advisors and your advisors during the due diligence process. So prepare for due diligence. So you're really, really close to that investment. We're really right at the top end of that investor readiness before we really engage. Listen, I'll maybe pull some slides together to simplify that and clarify that a little bit. I know some of the terms are quite similar, so there's quite a lot of subtlety in there. I think that worked for me to get that out of my head. Hopefully it worked for you as a listener. Thanks for listening.